welcome to our special noon webinar on the budget and what it means for us and Queenager and what we like to call at noon Queenager financial spanks. I think we're calling it at the moment Queenager financial finesse, but I think it's the same kind of thing, which is where we try and do a very kind of noon take on the kind of financial advice and things that we need to know. Lovely to see lots of friends joining us. Hello, particular shout out to Geraldine. Hello, hello, darling. Haven't seen you for a while. And to Fleur, always lovely to see you. And lots of other ones there. Hey, Geraldine, lovely to see you. Haven't seen you for a while. And lots of others coming in too. Great to have so many of you joining us. Let's just give everybody kind of a minute or so to come in. But I hope you're all having a lovely day. It's beautifully sunny where I am in London. We seem to have lost the storms. And we're really happy today to be joined by two amazing Queenagers from our partners BKL who really know their stuff on all of this. So we're going to be all asking them lots of good questions. And as we always say at these noon events, there really is no such thing as a stupid question, or if there is a stupid question, it's probably the one I'm going to be asking. And so we really want you to kind of use this opportunity to have, it's amazing to have Muv and Emma with us who really know their stuff. So really make the most of that and put your questions in the chat. And we're going to try and make this as informal and as lively and as acronym free as we possibly can, because we know at noon that sometimes us Queenagers can be slightly put off by things financial. Personally, I know I sometimes approach my tax return with a combination of fear and of kind of terror and boredom, which is a particularly noxious combo. I know some of you will be thinking you've got to get your tax returns done kind of over Christmas and that kind of thing. So the point of this session is to really explain as much as we can some of the changes that have happened in the budget and how they affect us as Queenagers, or the kind of things that we should be thinking about as a result. And I think the fact that we had nearly 200 people sign up for this webinar shows that there is a real appetite for this kind of information, and that often the way things are covered in the press, very sorry to my former brethren, is not necessarily exactly, it's not necessarily served up in the way that we want it, or in a way that feels that understandable or digestible. So what we're going to try and get at today is a real sense of what the budget means for Queenagers, and more than that, a chance for you to ask Emma and Mav their opinion on maybe things which are bothering you. Remember, we can't give you specific advice. We can't say this is exactly what you should do, but we can say these are the kind of things that are a good idea. So just to understand the kind of the difference in that. So I think we've got lots of everyone's already putting their questions in the chat. Good to see that that's all happening. Also, tell us where you can tell us where you are if you'd like, or what. And Jen has just shared a poll of some of the kind of, so what we've put out here are some of the things that we can talk about today. And so it'd be really interesting to know from all of you actually on the call which of those things on the poll that Jen's just posted in the chat is most pertinent to you, because then we can focus on those things. And don't worry, we're also going to have a good look through your questions and answer all of those too. So I think we should get cracking. There's still some more people joining, but they'll have to catch up. So welcome to this noon webinar on Queenager finances, everything we need to know, what's changed out of the budget, but also a bit of a kind of more general look at the kind of things that we should be thinking about at this point in life. And as I said earlier, there are no stupid questions. Really feel free to ask everything you want to know in the meeting chat, and or put your hand up and we'll take some questions directly to Emma and Muv as we go. So just to introduce our very distinguished panelists, we've got Muv, Bain and Pollitt.
Well done.
Is that right? I know that you're called Muv, but I was not very sure on the surname, so I'm very sorry about that. I hope that's in the right place. And Emma Jordan Brown, both of whom are very senior at BKL, who are our partners. You may have seen our stuff around BKL in the newsletter. We decided to partner with them because I kept getting asked by Queenagers about their finances and who I use and wealth planning and all that kind of thing. So I thought, well, who better to recommend than the people I actually use myself, BKL, full disclosure, are my accountants. They've helped me in founding two businesses at 50. I was a good journalist, but I knew nothing about business or anything I needed to do to keep myself safe as an entrepreneur, and also as a somebody kind of moving into from being employed into being self-employed and all of that kind of thing. And I really recommend taking some financial advice from people that you trust. So that's why we partnered up with BKL, because I recommend them because I actually use them myself. So, Mav, do you want to kick off a bit, telling us a bit about you, and then Emma, do the same, and then we'll get to some questions. Welcome.
Awesome. Thank you so much. How exciting to be here. It's been awesome seeing all the names ticking up. It's brilliant to have so many people in the room. So I'm Vanoy. Everyone calls me Muv, Muv like love, from BKL. I'm one of the partners at BKL. I'm an audit partner by trade for my sins, property specialist as well. So that's part of my background, but I'm also a board member at BKL, and specialise in governance and sustainability. So I've got many hats today and I'll bring whatever's useful. But there we go. That's me in a nutshell.
Brilliant, thanks, Mav. And Emma, tell us a bit about you and your specialities.
Hi, everybody. My name's Emma Brown. Emma Jordan Brown is my married name. Excuse me. I head up the tax consultancy team here at BKL. So obviously lots of conversations going around the budget after last week. So I will try and help you out as much as possible. And Eleanor promised I will answer all of your questions. If there's anything I can't answer, though, I will make sure that we do follow up with whatever is still outstanding after this webinar. But I'll do my very best. Just to give you, I guess, a bit of background about me, I am a mixed tax advisor, which means I advise individuals as well as companies. So really well placed for anybody that's, an owner manager in the same way as Eleanor is. I think, there are things that you need to think about in your company that impact on your personal decisions and vice versa when you're owning and controlling your own business in that way. It's very, very important. And it's the majority of our client base, so entrepreneurs and owner managed businesses. So hopefully I can cut across all things tax today. I'll do my very, very best. Just to give you a bit of background and a bit of, I guess, female power, I was the first ever internally promoted tax partner at BKL, and I was the first ever female tax partner at BKL as well, at the tender age of 35. So I also sit on the executive committee alongside Muv. So yeah, hopefully you'll be rest assured that BKL are very, very female friendly, and there's a lot more of us behind the scenes, which hopefully you'll get to meet more of the team as these webinars go on. Thank you.
Brilliant. Thanks, Emma, and thanks, Muv. So let's jump in. So Muv, as somebody who's pretty expert in this field and who's also a proud Queenager, what would you say are the key things that we all need to be aware of in the budget?
So I think what's really interesting is that a lot of the stuff that's come out of the budget, and Emma will talk about the tax in a lot more detail, is, talks about freezes. Talks about freezes and what does a freeze mean? And that's the kind of thing that is they call it stealth tax, they call it all sorts of stuff, right? But what it really means is that the cost of living goes up, that the tax, the rates at which you pay tax stay the same, so you end up paying a lot more tax at the different levels. So what it means is that for all of us, as we keep earning more, or the cost of living goes up, also the proportion of tax that is taken out of our salaries actually increases by quite a lot. So to the extent that, which I thought was fascinating, to the extent that now if you get state pension, that you will be taxed on a proportion of your state pension, because the minimum tax-free allowance is now less than the state pension amount, which it's kind of that piece that goes, goodness, do you know what? It says that things aren't changing too much. There are changes, but what it really means is that by staying the same, it creates a bigger impact than you imagine. And that's a piece of the jargon that sometimes gets lost in the noise when they say, oh, it's been frozen. So you think it's a good thing, but it's not really.
Okay, so it's going to catch more people in that tax bracket. So because inflation is going up, and so wages are kind of going up with inflation, the tax bracket the tax threshold's being frozen. So actually more people are being caught in it.
More people are being charged higher rates of tax now because their salaries are going up.
Okay.
Yeah, and I think
to
dispel one of the terminologies there that Mub uses, stealth tax. That's been something that's been, something's been banded around a lot over the last few days. And the reason why they're calling it stealthy in this way is because they haven't actually increased the rate of tax. And because of that, Rachel believes she hasn't broken her manifesto pledge, which we won't get into politics or political persuasions today. I fundamentally disagree with, for the reasons that Mub mentioned. So that's why stealth is being used, because they haven't actually increased the rates. They feel as though they haven't changed anything, but what it will mean for the pound in your pocket is that you get less of it. So you
Right.
will feel the pinch, you absolutely will, but because it hasn't been a technical tax rate change, it's seen as stealthy. Does that make sense?
Yeah, no, that's really interesting. So basically, we are all going to, although she says she hasn't put up income tax, in effect she has, because
Yeah.
she's frozen the level on which you get hit, which actually means she's lowering the threshold at which you have to pay more tax.
Exactly that,
Effectively.
Eleanor. And I think what it does really is it doesn't have an immediate hit in terms of the finances in the coffer of the exchequer, and actually spreads that over a number of years. And you'll have heard everybody saying, this raises up until 2030, right? That's just the end of the term of the government. Ultimately, though, what it enables Rachel to do is say, I didn't tax you all right now. I've tried to spread that out for you to ease the burden and ease the pain. What fundamentally it does is kick the can down the road, though. It doesn't actually fix the problem right now. So again, slight mixed messaging, as is always the way in politics. Let's be fair.
Okay, so basically, what we need to take away from this is that basically it's like a backdoor tax increase that we've all had.
Yeah.
Yeah,
Okay.
absolutely.
Exactly right. And
Excellent.
Emma, isn't it the case? Sorry, isn't it the case, Emma, that it's been frozen in this way for the past almost like 10 years?
Yeah.
Absolutely. I think tax allowances across the board have not been raised enough. And this is over consecutive governments, right? I don't think there's one government to blame in this particularly. But
Yeah.
you take something like inheritance tax, that the nil rate band for that has been stuck at 325 for decades. And again,
Yeah.
it's what's relative and relative to right now in everybody's financial situation right now. And I think that's the difficulty when you freeze rates in the way that you mentioned it, explained earlier, Mov. You're not taking the current cost of living into account. And that's what creates more of a tax burden on the average Joe.
Yeah, and we know that there's been big inflationary pressures over the last few years because we know that prices have gone up. And
Yep.
okay. So what we put there for you on the screen is a slide showing what the thresholds have been stuck at. And don't worry about having to write these down. We're going to share with you all the slides that we've got here at the end. We're just going to try and make this very unslide heavy because we know that can be quite a bit of a turn off in itself. So the other big changes in the budget are around dividends and property, yeah, and the savings and savings. So should we go into that a bit? Let's go into what the savings on because everyone will have heard about ISAs and things like that. We'll come back to dividends and properties in a sec, so it's slightly more technical. And
Yeah,
let's start off with the savings and the ISAs, shall we?
Yeah, I think ISIS is still a good play for most people, right? It needs to be a blend of things, and obviously there's an annual allowance for the amount that you can put into an ISA. But from an income tax or a capital gains perspective, you're not paying that right now. They're exempt still from those. They do fall into the inheritance bucket still, so let's bear that in mind. But it means that any interest that you're getting off of your savings is not being taxed on you right now.
Okay, can we have the slide which is specifically about ISAs? I think it's the next one. Because there's been a change, hasn't there? So until now, you've been able to put £20,000 into an ISA, kind of tax free every year. But the government have now changed that, haven't said that, so that you can only put £12,000 into an ISA. Is that right?
Exactly that. Yeah, they've brought that right down. And bear in mind, that is an individual limit, So if you've got a wider family, you can, for example, set up ISA for your children if you have any. That doesn't
Okay.
help a lot of families, though, right? Let's be fair about it. So, even though it's an individual threshold, bringing that right down means that, people are going to have to invest if they want to outside of an ISA. And then, of course, you are paying income tax, Eleanor.
Okay, fine. But just to explain what this means in terms of, because we know that a lot from some other events that we did, that we know that a lot of Queenagers are very partial to a cash ISA.
Yep.
And we did a thing around Queenager financial spanks last year where we discovered that practically everybody in the room understood about their cash ISA and was putting money into it, but that they were much more resistant to putting money into stocks and shares. So can you describe to us maybe Mav, the kind of the difference here and why the government have done this?
So I mean, part of the reason is that they want to force people to divest how they're handling their money.
Yeah.
I think they expect that fewer people will put money in People will stick to the 12 instead of putting the full 20 in because they'll be worried about or nervous about putting, money in stocks and shares. So it creates almost like a new limit for the tax-free amounts that are able to be saved. What's really interesting, I'm sure Emma's got some thoughts on the tax side, but what's really interesting from an investor side, and I don't know how many people here have an individual, an IFA to help them with their investment strategies.
An IFA, for on acronym watchers, independent financial
advisor. That's right. So, and what's really interesting is it isn't actually that difficult, and it's not actually that complicated. It just sounds. It sounds trickier than it is to put money in these stocks and shares ISAs. So it almost like creates like an artificial step that someone has to do something that sounds harder to save their money in a more tax efficient way. And I'm not sure what you've got on the tax side.
Mav, can I just jump in there too? It seems to me, as somebody who has both cash and stocks and shares ISA, that it also means as a country, all of our ISAs are much more exposed to the vagaries of the stock market. Now, of course, we know the stock market has been a great place to increase your wealth over the last however many years and decades. But I think, for Queenagers in particular, we'll want to make sure that any kind of stocks and shares investing via the ISA it really matches our risk profile, or how worried we are about any of that savings to kind of go away because the stock goes down.
Mav, do you want to speak a bit to your own experience of this? Because one of the things that's come up before is what is an independent financial advisor, and what can they do for you? Why would you need one? What kind of person needs an independent financial advisor? How can they help?
That's a really good question, because I didn't have one for quite a long time, and probably maybe when I got divorced, actually, I began thinking, gosh, I need to get a bit more structured around my own financial advice. I'm an accountant, you'd think I'd understand, and I do, and I understand enough to talk to clients about it. But then when it comes to taking the plunge and making some difficult decisions myself about what my own personal risk profile is, or where would I put my money, I felt that it was really important for me to get some additional advice. So it's an independent person, the clue's in the name. It's an independent person that's not affiliated with any particular stocks or shares or investment profiles, and their job is to give you neutral advice that you can then listen to, understand, and take. So I found that really helpful. It was really interesting because when I first started working with an IFA, I was like, no, my risk profile is low. No. I'm a risk profile number 1. They ask you to go 1 to 10. And I was like, I'm number 1. I'm an accountant. That feels right for me. But the longer I've been working and investing, I'm kind of going, do you know what? I could take a 6 on that one, and I could take a 4 on this. And you become a little bit more flexible as you become more confident, I suppose, in making those sorts of decisions. Because it's quite scary if somebody says, how would you feel if you lost all your savings overnight? And I'm like, well, that would be awful. No, I'm a naught on this, So, and then you realize it's not actually that scary. And their job is to explain things to you in a way that you can make a really good decision. Some of them are more, and you have to move around a bit and find somebody that really works with your personality. And somebody that will take the time to explain in a way that is clear, because some people just, bamboozle you with I'll give you an example. I've got a sustainability background, and one of the things that was most important to me was to make sure that I was getting advice from my advisor that was linked with my values around sustainability. And one IFA I spoke to said, you'll never make any money on that, don't do it. And then I spoke to another, and they said, no, there are loads of really valuable options that you can look at, and just take a look. And it was just another way of looking at it. And I'm very happy with my sustainable portfolio now, but it took me a little bit of moving around to find the right person.
Yeah, I have to say, speaking to that, Mother, I took my pension out of because I worked for News International for a long time, so I had a lot of money in there, and I could move some of it out, and I transported some of it out, and I put it all into kind of gender impact, sustainability. I had a kind of halo pension. I was so virtuous, and I have to say that the bit of my pension that was in kind of child labour and guns and oil, which I couldn't move, has definitely gone up a lot more. But I have to say that I feel good about the choices that I've made, and you're right that it has come back. And so I think what's interesting about being an investor, and I'm relatively new to this as well, is you can very much align your portfolio along your values. I invest in a lot of kind of gender impact, so that's investing in women's projects. I invest in a lot of women in actually in South America and that kind of thing. And so I think it's quite fun to have a sense of agency about what your money is doing in the world. And certainly if you care about climate change, putting your money into kind of green investments is actually one of the biggest effects that you can have, much more so than recycling your, plastic milk cartons. If you actually move your money into sustainable stocks and shares, or things which are, about renewable energy and those kind of things, you not only make money on the money that you've got in the bank, but you're also helping to make the world a different kind of a place. It's actually one of the most powerful things that we can do as individuals.
That's right. And that's one of the reasons I moved, because I wanted to have that ability to make that choice.
Yeah, and I think that that's something that really resonates with us kind of at this point and as Queenagers. And I think that by Mav said something really interesting in the run up to this call. You were saying that not making a decision, leaving all your stuff in a cash ISA, or just having it in your current account, that is a decision about your money. And it's kind of possible to take some quite baby steps in this. Maybe get yourself a cash ISA, maybe put a bit of money, if this year you can't put all 20,000 in a cash ISA, put 12,000 in the cash ISA and try the 8,000 in some stocks and shares. You can start off with a very low risk, some gilts or something like that, and then you can always then you can ramp it up if you slightly get the bug. I agree, like Mav, my risk profile's gone up a lot. In fact, I've taken much more risk than my husband's, much more risk averse, so, and we have a kind of joint thing. But it's kind of one of those things that you can kind of begin to play with as you become a bit more confident. And Emma, I just had a look at the poll, and I noticed that salary sacrifice and inheritance tax are what people are most interested in knowing a bit about. So will you take us through salary sacrifice? Because I certainly find that quite complicated, but I know that that applies to a lot of the women here. Jen, do you want to give us the salary sacrifice slide, please?
Of course. So I think let's explain the term.
Yes,
What it means
good
is,
start.
right? What it means is, so if you get a salary of let's say £50,000, what you're saying is, I want to forgo an element of that salary and receive something else instead. So quite often pension contributions are structured in a way of salary sacrifice. And let's say, for example, you put £5,000 in, it would reduce your salary from 50 to 45, because £5,000 is then going in your pension. So you are foregoing your salary, which means obviously your taxable salary then goes down accordingly. You're only getting taxed on the 45. So it means that it's coming out of your salary before any tax, before any national insurance. And that obviously then has a saving to us as an individual, because it means we're not having to pay out of our paycheck when we receive it, which has already been subject to tax and national insurance. Hopefully that's clear.
Yeah, no, that's good. So currently you're allowed to do this, but the rules are going to change in April 2029. So if the women on the call are currently doing that salary sacrifice, should they go on doing that?
Absolutely, certainly until April 29. And look, anything can change in politics, and 3 years is a hell of a long time for any policy change. So everything's up for grabs until then, honestly. So while it's still here, I would recommend absolutely making the most of it. Anybody that isn't paying into salary sacrifice right now, you've got 3 years as a minimum left. And I would very much hope that everybody sees sense before then.
And that you should do it, because basically it's a way of putting more money in your pension tax free.
Absolutely, yeah. And most of the time, the employers will contribute a little bit more as well, because you'll see on the slide here, it says that pension contributions now by way of salary sacrifice, the employers are going to have to pay national insurance on that. So, whether they're paying you as a salary or paying into your pension, they're paying national insurance either way. Now, what tends to happen at the moment, Eleanor, because they don't have to pay national insurance right now on your pension contributions. Usually what an employer will do is give you the benefit of some of that. And they'll say, look, we've saved an amount of money. We're going to put, let's say, half into your pension, and we'll share that benefit between us, which of course then is helping everybody's pension pots grow. So the reality of this change is it's not necessarily a money raiser. The money was being paid one way or the other, but instead of it going into your pension pot, It now goes into the exchequer coffers.
Okay, so that's basically another way that Rachel Reeves is taking some more money of us.
Absolutely.
Okay, so that's really helpful on the kind of technicality of the salary sacrifice. And now can we have a look at inheritance tax, which I know is a big thing for lots of Queenagers, both for themselves, but also because they might be in a situation where they're going to be inheriting money from a parent. So what are the big changes here, Emma, and what do we need to look out for?
The big changes are the ones at the top of the slide there, Eleanor. Agricultural and business property relief. Anybody that's an entrepreneur has been hit incredibly hard by the business property relief changes. The
Okay.
acronym is BPR, and apologies for the acronym here.
And can you tell us what business property relief is? I'm an entrepreneur, I've got no idea.
Yeah, absolutely. So, if you've got a company, those company shares, if you were, God forbid, to pass, they would be able, at the moment, to be able to go down to your family without any inheritance tax. It was fully exempt. The value of your business was fully exempt, and you were able to pass that down to your family free of inheritance tax.
Wow, and you now not?
Well, you are up to £1 million. Now, a
Okay.
lot of people will sit here and say, it's £1 million, you're a millionaire. Why shouldn't you be paying tax over and above that? That's an incredibly high limit, I
Yeah.
think, for most people. However, when you speak to an entrepreneur, and you'll probably attest to this yourself, when you've gone through that journey of starting something up from scratch, 9 times out of 10, you are borrowing to fund that business, usually with a personal guarantee.
Yeah, like on
Usually
your
when
house. Yeah.
Absolutely, right? Usually when you're employing staff, you make sure, frankly, they get paid first, and you
Yeah.
tend to pay yourself last.
I didn't take a salary for the first, I still don't take a kind of salary out of me. Yeah.
So I think people forget the sacrifices that entrepreneurs have made to be able to trade and employ people and put money into the economy. And so, unfortunately, the kind of misconception that £1 million is really, really high. You can have, what most people, again, to use a term, a lifestyle business,
Yeah.
and a lifestyle business means effectively you earn enough money to sustain your own lifestyle.
Yeah.
You're not earning loads above that. You don't have much, a lot of disposable income, but you're very comfortable in your way of living.
Yeah.
And anybody that's a lifestyle business, you can still reach £1 million valuation fairly easily.
Yeah.
And I think actually,
particularly if you've got an office or something, or if the company owns some property.
yeah, absolutely that. Usually we would value a business, let's say, at the end of, you've got your income, you've left all your expenditure, and you've got your net profit at the end. Really basic valuation principle, 5 times that profit is what your business is worth.
Okay.
Right. So, you can get to a position where you can make a couple of £100,000 at the end of the year, and that's tipping you into this £1 million already.
So that's not running a business, that's not Nike.
Exactly that. And I think, to put this into real terms, though, Eleanor, what it means is when you pass, your business assets down to whomever you wish to benefit from those on your passing, they're not going to have any cash. Right? All they've received is shares in a business. It's not liquid in that way. And when we say liquid, it means it is not money. I'm going to have to liquidate it. I'm going to have to sell it, in effect, to get that money.
Yeah.
So what that means is, any family businesses that have been passed down generations, it's going to hit the next generation. They're going to be hit with an inheritance tax bill that they can't pay. And they're going to have to sell their family business to pay for that inheritance tax bill.
So we've all heard about this a lot in relation to farmers, haven't we? And kind of family-owned farms, where, again, it sounds like £1 million sounds like a lot, but actually that's probably just the value of the land and the kind of tractors and stuff. And if you have to pay a huge amount of inheritance tax on your tractors and your land, then you're not going to be able to afford to farm it, right, in the next generation.
Absolutely.
So is this a similar kind of hit on businesses?
Absolutely. Exactly that. So, if we look at farming, unfortunately now, again, it's an asset, it's not cash. So when the next generation get hit with that inheritance tax bill, they're going to be selling off all this amazing farmland. They'll be selling it to developers, right? And a load of houses are going to be built. The only people that win here are property developers, unfortunately.
Yeah. Okay. So that's a kind of tax raid. And then on the other inheritance tax changes, what else should we be aware of? And are there things that we should be saying to our parents that they should be doing to try and, avoid this as much as possible, or not? Or is there not much anyone can do?
Oh, I think if you follow my dad's advice, spend it.
Spend it. Yeah, that's what my mum said to me.
Honestly, my dad's been very open and honest and said he's only going to leave me with debt, which I love, right? I want my parents to be able to enjoy their lives ultimately, lifetime gifting is a really, really good way to avoid inheritance tax on the estate at death.
Okay,
So
so,
enjoy your life.
give
And
your money away to your kids while you can.
absolutely. So if you're going to have a chat with your parents, tell them that.
I mean, if it's useful. So my dad's a farmer actually, and what's really interesting is, bless him, he doesn't have a will. So when we're thinking about talking to your parents, and it's not easy, because I know that when I try to say to my dad, hey dad, put a will in place, you can get insurance to cover the inheritance tax. There's lots of things you can do. And he's like, Mavano, I don't want to talk about money with my daughter. I'm like, right, what can you do? It's not straightforward to have these conversations with your parents, but I think it's really important that, there are basic tax planning tools, tricks, tips that you can put in place relatively easily. That, I mean, it doesn't negate all of this work, but if you know that your parents, or the people that that you yourself actually haven't got a plan in place, just get a plan in place. The worst plan is no plan in terms of inheritance tax.
And I think that that's particularly true when it comes to a will. I mean, lots of you here will have been to a noon circle. We've had lots of in the London circle recently about what a couple of the Queenagers have had women who, have had parents who've died without a will and have had real problems with kind of probate and that kind of thing. So I think the first bit of any kind of inheritance tax kind of thinking is, have you got a will? And that's also something that BKL can help you with. And the other thing is power of attorney. If you both over for your parents, particularly if they've got problems with Alzheimer's or dementia or those kind of things, and that can suddenly happen. That can happen very fast. So I think it's also one of these things where it's really worth having that conversation before the point at which it's necessary to really think about, what would happen if they if they kind of lose their marbles, or they need you to kind of help them, and how that's going to happen. And this sense of how, having a will makes it much easier for the people that you leave behind.
And it's really funny, I think, when I talk to my clients about inheritance tax, Eleanor, there's this real sense of, I don't want to talk about my own mortality.
Yeah.
And people go one way or the other. They absolutely want to have the conversation, or they absolutely don't. There's very few people that sit on the fence with this.
Yes.
A lot of people that don't do anything at all come at it from a view of, it's just not my problem. I'll be dead. Somebody else has the tax bill. I don't care. And look, that is an opinion and a view, and I'm not here to judge that. But what it does do, unfortunately, is leave the next generation with a lot of mess to clean up, and actually very little power to do much about it. Because a part of the will, it's not only, this is how I would like to pass down my estate and who to, but I trust these people to administer that and make sure that happens correctly. And those people, they're called executors of the will. They are able to make decisions about those assets, and they have that power. Where you don't have a will in place, those people aren't appointed.
So then there's a vacuum. So we've got a really good question on the tax on the chat here on the chat from Emma Stopford. She's saying, question in two parts: what insurance can you get to cover inheritance tax? That's a good question, Emma. And also, do you have any arguments to persuade a reluctant parent to do some planning? What would be your most persuasive arguments? Great question, Emma.
Honestly, do you want to give your money to the government?
Yes, okay, that's good.
I think that's ultimately where it comes down. And again, depending on somebody's political persuasion, depending on what party's in power, they might be more inclined to say no to that question. A lot of people, though, Eleanor, don't think they've really got anything to pass down. That's another part of this. But ultimately, anybody with a house or a pension, you're having the conversation, irrelevant of the value. As I said, £325,000 is the nil rate band right now.
So 325,000 is what for what you can hand down without getting any inheritance tax.
Exactly that.
And so that's not very much. So if you've got a house, it's say in London, which is worth £1 million, how are you going to have? So if your parents die and they've got their house, you're going to have to pay 40% of the difference between 325 and £1 million.
Exactly.
It's a lot of money.
No, there were some slightly higher rates where it's property that somebody's lived in. But parking those funny rules for a moment, you can have somebody that bought property in the 80s for 10, 20 grand, and it can now be worth £1 million. Right? You don't need to be, I think, somebody that's a high earner to have a high value asset.
No, for sure not, particularly in
You
the
know, and
southeast.
I think people forget that a little
Yeah,
bit. You know, even my mum and dad's, you know, 2-bed bungalow in Bristol blows that. And they
yeah,
didn't pay very much for it 15, 20 years ago. That's just kind of the value that's built on that property, you know, over the years. So I think I would really recommend anybody that just thinks that their affairs aren't complicated enough or valuable enough to get a will, because, you know, they fall under those limits. Number
yeah,
one, you might fall under those limits, but equally your assets might not go where you want them to.
yeah.
But more importantly, I would strongly suggest they probably are over that limit.
And
So
so
it's
what can you do? So say your parents are, sitting in a house which is worth £1 million,
yeah.
okay, and they've made a will. What can you do as the person who's going to benefit from from that? There's a bit of stuff in the chat as well saying I thought property was only 175,000 before you have to pay inheritance tax. Can you give us the actual thresholds, Emma?
Yeah, so where you have a property that you've lived in and you pass it down to
So
your
it's your so
family in
it's
the
your
right
main
way,
residence.
exactly that. You get
Yeah.
a slightly higher
Okay.
nil rate band, which is
Okay.
really helpful. The other thing that happens is if one of your parents dies before the other
Yeah.
and they've passed everything to the surviving spouse,
Yeah.
their nil rate bands come over as well. They get transferred. So you
Okay,
can end up
but
with quite
when
a
they die and it comes to you, so it comes down the generations, then you are going to get hit with it.
exactly that.
And is there anything that you can do in that situation? Or is there any
Um,
planning that can be done so that the money doesn't go to the taxpayer? Sorry,
yeah.
to the taxman?
Number one is your will, because you need
Okay.
to understand where those assets are being directed. There can be some IHT breaks where you donate a proportion of that to a charity as well.
Okay.
That can be helpful, but not everybody is that way inclined. Ultimately, when you're looking at the value of your estate, you know, it used to be things like BPR and APR, agricultural and business property relief we were talking about earlier. They were
Yeah.
really, really good IHT protectors. You were able to skew your stocks and shares portfolio in a way that might benefit for BPR
Yes.
in some
So if
instances.
you had agricultural land or you had your money in your business, then you could pass it down to your children without it hitting the tax. So that loophole's gone.
It
And
has.
isn't there something also new about taxing the amount of money you leave in your pension now as
Yeah,
well? Isn't that a
absolutely.
new change?
Yeah. So again, before there were IHT reliefs for passing down your pension, and don't get me wrong, there were, you needed to be by a certain age and it needed to go to a certain person. All of those have been taken away now as well. So your pension forms a part of your estate. So whereas some people might not have drawn down on the annuity income from their pension when they came of pensionable age because they didn't need that income and
Yeah.
they were really comfortable with passing that down to the next generation, those people are going to start taking income out of their pension now. There's no reason for them not to. So take it out and spend it.
Yeah. But it seems an incredibly unfair tax because all the money that we've already got in our pension or that we've saved during our lives, we've already paid income tax on, or, capital gains tax or kind of dividends. So this is like an extra tax on everyone who dies.
Exactly that. Yeah. And
Really?
ultimately, anything that you have as an asset, you either earned money to buy it, or
Yeah.
you sold something and made a profit to
Yeah.
buy it. Right? That money came from somewhere. So any asset that you own usually has been purchased out of earned income and taxed income. So you're right.
Yeah.
Inheritance tax is another tax again on that.
Yeah.
Double
Okay,
whammy.
so we've got some questions in the chat now about dividends, which I'm also interested in as somebody who's self-employed. Becca said, while I appreciate everyone's circumstances different, for those of us self-employed with a limited company, does there become a point with the new 2% dividend tax where it becomes better to take a bigger salary than pay yourself through dividends? Because a lot of us who are self-employed, or have a limited company and are kind of entrepreneurs, rather than taking a salary, we pay ourselves through dividends, and they basically up the tax on that. So is it becoming, less of an advantage to take dividends rather than income?
It already had.
Okay.
So when they hiked up dividend tax rates a few years ago, unfortunately that kind of benefit got eroded at that point, Eleanor. So an additional 2%,
Right.
absolutely, in most instances will put it beyond doubt. Rewind, it always used to be people would incorporate into a limited company rather than being a sole trader. You
Yeah.
would take your basic rate salary so that you hit all of your state pension boxes, right? So at that point, it used to be 10, 12 grand.
Yeah.
And then everything else you would take as a dividend because you didn't pay national insurance on it.
Yeah.
Right.
And the taxation rate was lower than on income.
Exactly.
And is that now not as beneficial?
Absolutely, yeah. I mean, when they brought in the first kind of hike on dividend tax rates, you know, you're 7.5 and it went up to 39.25, I think, back then. As soon as they did that, the reason they did it was so that the differential between taking a salary and a dividend was basically on parity, and it stopped people incorporating and going into companies because it wasn't as attractive. That was the reason they did it back then. So you're right, an additional 2% now almost certainly erodes the benefit of a dividend. And when
Emma, can I just, this is Jennifer from Noon, just jumping in. Is there a reason why the government would want to keep people from incorporating? I mean,
I honestly, Jennifer, I can't answer that question because it doesn't make any sense to me whatsoever. What a company provides somebody, let's be honest about it. Anybody can trade as a sole trader, or you can incorporate and trade through a company, right? What the company offers you is legal protection.
Yes. One of the problems I had with my previous business, Brit Mums, which was very successful for more than 12 or 13 years, was that a couple of different things came about where it was becoming impossible for us to remain a limited company. But as a result, we couldn't work with some of our big clients. I mean, that included Coca-Cola or Boots or whatever.
Yeah.
They won't deal with a smaller
trader.
business, with sole trader or even a partnership.
You're absolutely right. I think most of the larger firms, if they're going to contract with you, want it through a limited company for that reason. You know, it's held as a separate legal entity. You know, you can sue a company. And I think I don't really honestly understand the reason why they would look to almost be suggesting that you shouldn't trade through a company at this point. It doesn't make any sense to me. I'm sure there is sense somewhere. I'm sure somebody's thought about this. But ultimately, again, and to kind of, I guess, go right back to my original point, the Chancellor is saying that she hasn't broken the income tax pledge in her manifesto. Don't get me wrong, the raises on dividends, the raises on savings, and the raises on property, they're all income tax. They're just called something else.
Yeah.
Right? She's just taken different income types, and therefore the terminology that we use from a tax perspective is slightly different. You call it a dividend tax rather than an income tax, if that makes sense. But it's a technicality only.
Yeah, but it's basically an income tax on people with small businesses who pay themselves from dividends. It's the way they take their income. So it is an income tax. It's just called something else. You're right.
Yeah.
And Marie is saying, if you're a grandchild living with parents who are living with their parents, could the property be gifted or put in trust for the grandchild and be free of inheritance tax?
Unfortunately, there's something called gift of reservation of benefit, which is a bit of a mouthful. But if you take it literally, it means if a grandparent in this situation gifted to the grandchild, that's quite helpful because you're knocking it down 2 generations, which means you're kicking that inheritance tax can hopefully much further down the road. But where they're still living in that property, or they can still benefit from that property, then all of that is looked through and the planning is
okay. So you can't do that. So basically, if you're all living in the same house, then it's still going to count as their house, even if you try and do that.
Exactly. The way around it, Eleanor, is to charge your grandparents rent. That'll go down well. Try that one.
No, and I think this is really difficult. I think there's a big kind of psychological thing, because I'm really sympathise with some people in the chat saying, how do you have that conversation with your parents? Because that's certainly a conversation that me and my sister have been trying to have with my mother for years, because she was like, oh darling, you'll inherit my flat. But the reality is, because the inheritance tax will be so high on it, we'll have to sell it. And we've been trying to say to her, because there's a 7-year rule, isn't there, around gifts?
Lifetime.
If she'd done that, then we might be able to do it. But now it's getting a bit late. She's getting quite old.
Yeah, look, the 2 big things that help you with your inheritance tax exposure is gifting away in your lifetime.
Yeah.
So we call that a potentially exempt gift. And that's the 7-year rule that you're talking about.
Yeah.
So if you gift it away and the person gifting survives 7 years, no inheritance tax, you're fine.
Okay.
If they die within that 7-year period, there is an element of inheritance tax to pay. And once they've survived 3 years, that becomes less and less and less over time, which is the reason why we call it potentially exempt.
Okay.
So that is something you can do. The earlier that people gift, the better, because obviously the more likelihood is they're going to survive 7 years. right? Being
Yes.
brutally honest about it. The other good thing to be able to do is once you've got yourself to a position where you've done all of your investing, you've invested in the most tax efficient way you can, you understand where everything's going. If there's a residual IHT liability, and Mov mentioned it earlier, you can insure against that. So you
Okay.
can pay a premium now that says, okay, on my death, I know that my beneficiaries are going to have to pay inheritance tax of this. So I'm going to pay an insurance policy now that will pay out when I die to make sure that inheritance tax liability is settled on their behalf.
Okay, and how expensive are those kind of inheritance tax policies? Are they quite expensive? Because you know,
They
in a way,
can be. It depends how old the person is, right? If you're
Right.
younger and in better health, actually the premiums can be incredibly low.
Okay, so that
Unfortunately,
might be worth looking into.
And
definitely.
and Emma,
Yeah.
is that something that if I were to come to BKL as a client, y'all would be able to say, here are some, here are these kind of policies, here are some options, that kind of thing? Is that the kind of thing y'all advise on?
Absolutely. Jen, there are a few people that can advise on this. And what you want to make sure is these three people all talk to each other, okay? So your tax advisor will be able to do it. Your independent financial advisor will be able to do it. And the lawyer that does your will be able to do it, okay? Now, what you want to make sure is that these three people are talking to each other, that they don't try and point score off each other, right? Because
Yeah.
what quite often happens when you've got more than one professional advisor in the room is somebody will go, okay, well, I've suggested this. And somebody else will go, oh, but I know a bit better.
Yeah.
And you get this point scoring mentality. You don't want that. You want all of your three advisors talking to each other very well, discussing, sharing ideas, and coming together with a joined up plan, because that way they're putting you front and center. They're not trying to point score. They're trying to make sure that you, as their client, are best advised.
Yeah.
Yeah, and
That's a
so this
benefit. Sorry.
sense of a team.
Well, I was just going to say that's would be a benefit of going to a place like BKL because I could get all that information in one place.
Yeah.
So we're not lawyers. So I need to make that really, really clear. We don't offer legal advice. We do work with, a great list of fantastic private client lawyers that would be able to recommend. But as Mov said earlier, I think you want to make sure your advisors work best for you. So we always recommend at least 2 or 3 advisors in any different capacity. Call all 3 of them, talk to them, help, understand who you connect with. Ultimately, you want your professional advisors to be people that you trust and that you can communicate openly with. Because if you don't tell them everything, they're going to advise you incorrectly. It's not going to work. Okay. So I think you want to go to, if you have one advisor that you really trust, you can ask them to recommend other people because they will tend to recommend people that are very similar to themselves, I would say, as advisors. But you do a bit of research. Don't just go to the first one.
Yeah, I think that's really good advice. But I would also say, and BKL do wills, and they will kind of, they definitely offer a kind of joined up service. So you're not going to get kind of conflicting advice from those. People want you to explain lifetime gifts, and particularly what that means from November 2025.
Ultimately, it's giving your assets away before you pass. So during your lifetime. And that can be anything from cash or cars or chattels or stocks and shares.
And are there limits on how much you can give away?
No, is the short answer. However, you need to understand most of the time, if you're giving something away, it's a disposal for capital gains tax. So that, you don't want to be saving with one hand to pay tax on another. So it needs a little bit of consideration. There are some.
Sorry, so if you're in the receipt of a gift, you can get clobbered with capital gains tax. Is that what you're saying?
No, if I'm gifting to you, Eleanor.
Yeah.
So if I'm saying, okay, I don't want this asset anymore and I'm giving it to you, it's a disposal on me. I've still sold something. And where you're giving to somebody that is a connected person to you, so think about this, mainly family members are connected for this purpose, that is deemed to be at market rate. So even if you don't pay me anything for it,
right,
I will get taxed as though I sold it at today's current value.
Wow. And is there a limit on that? So can you give away kind of smaller limits without being hit with that tax?
£3,000 a year you can gift away from an inheritance tax perspective. But
Gosh, so it's got really tight. So if you're kind of, your mum is whatever is sitting on some a flat or some reasonable assets or a pension, it's quite hard to get them out of their estate.
Yeah, I mean, look, if it's real estate, it's not only capital gains tax we're worried about, it's also stamp duty land tax, by the way, which is another tax again.
This is not good. What would be roughly the maximum salary plus dividends we can take each year from April 2026 while still staying within the basic rate, says Julia. And a lady who runs a business, an entrepreneur after my own heart.
Oh, look, I think the basic rate band is being frozen, so it's about 50 grand.
Yeah.
You've got your basic rate, it's I think 12,750 at the moment. It's on the slide, so sorry, my apologies. These numbers move quite a lot, but
yeah, it's about 12,500, isn't it? So that's what you can earn without having to pay any tax at all. And then between 12,000 and 50,000, you pay 20%. Is that right?
exactly, yeah.
And then after that, it's 40, and after
40,
125,
and then
it's even
45.
more, isn't it?
Yeah. So the dividend tax rate's slightly different, and the savings again. So you've got slightly different thresholds and tax rates for property and dividends and savings, which is the reason why the Chancellor changed those, rather than your earned income on a salary is deemed as something different.
Yeah.
But it's all income tax, as I said earlier.
I mean, certainly what I found as an entrepreneur is that taking some tax advice and, talking to your accountant about the most tax efficient way to do things ends up saving you far more money than the cost of taking the professional advice.
I would absolutely hope so. I mean, any professional advisor should be adding value, right? You shouldn't be entering into a conversation that's costing you more than you save.
No, but I think that that's something that so people can, like, if you talk to an independent financial advisor or you talk to an accountant, yes, they will charge you some fees, but they will always save you more money than the money that you pay them.
The good ones will, Eleanor. The good ones will.
Yeah, well,
but the point there is around timing, isn't it? Because I might be saving you tax 5-10 years time, but you're having to pay my fee right now.
Yeah,
and
exactly.
so it's a timing point for a lot of people.
Yeah, and there's a trade-off. But I think what we've seen in the big piece of Queenager research that we've just done around women getting divorced in midlife, and what we also saw when we did the financial spanks and with our other kind of the other bits of research that we've done at Noon, is that most Queenagers are not taking enough financial advice. So only 9% of women getting divorced were taking any kind of financial advice.
Yep.
And that was often a mistake because they were very emotionally attached, say, to staying in the house that they'd been in, rather than thinking about the value of the spouse's pension or those kind of things. So what I think we would like to get across is that if you take some financial advice, you will probably almost inevitably be in a better financial position than if you hadn't, because they'll tell you things that you didn't know. And as the tax system gets kind of tighter and tighter, it's more and more important to have the right kind of tax advice and tax planning advice, because as we can all see, the inheritance tax rules are basically going to catch all of us. They were never intended to do that. But if now, if you're, you even have any kind of a house in the southeast, you're going to be hitting those thresholds.
Absolutely, yeah, undoubtedly. And I think when we're talking about this, it's really difficult to understand when is the right time. And we were talking about divorce earlier, right? I think you can come out of that situation, it's incredibly emotive, and frankly, trust is broken quite often. So you need to find the right person. Somebody I saw has put in the chat, how do you trust somebody?
Yeah, I was just going to ask you about what does trust look like when selecting advisors. I mean, I would say that for me, trust on selecting an advisor was being introduced to them by somebody I really trusted. So my co-founder at Noon had been a BKL client for like 20 years before she introduced me to them, and I really trust her. So that was a kind of good thing. And then I think it's about the chemistry between you and the people that you work with, and also feeling that they understand you, they understand what your business is doing, and that they're there for you in a kind of, in a way which is more than just a kind of business relationship. So I think there's also, it has to be a bit of kind of personal chemistry in this kind of thing. Do you think that's right?
Absolutely. I think there's a lot of products that I get seen being sold to people from a tax perspective that are totally inappropriate for them. If you're entering into a conversation with an advisor and they say politely, you don't need me right now, you're good, but come back to me if this happens or this happens. And they're almost not forcing you into advice where you don't need it. Great sign.
Yes.
I think when we talk about independent financial advisors, what does that mean? There are some people that are not independent. They work for, a firm, and they will sell that firm's products, whether or not they're the right product for you. If you've got an advisor that says don't go into sustainability when they know that that's your value, not the right person for you. But ultimately, I think where you've received advice and you cross-check that with an advisor that you do know and trust, does this feel right? Does this sound right? Please, 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 everybody on the call, do not cross-check advice with Google Tax. Google Tax is always wrong. And so is Bob down the pub. I get that a lot. My mate Bob down the pub told me this was really good advice. The difficulty is, and the right advisor will ask you why you want to do something.
Yeah.
If you say, okay, I want to do this, if they're going, okay, well, we'll do that, without asking you why, what's the intention? What are you trying to get out of this? If they don't understand why you're doing it, they're not advising you properly.
There's a really good question here about, do you coordinate advice with international tax advisors for people with assets and income in the UK and abroad? I've said yes, because I know that you
Absolutely.
do. Absolutely.
We're a part of an international association called DFK, and I sit on the International Tax Committee. So we do a lot of work around cross-border relationships. And the reason why we as a firm entered into that association is because, number one, we wanted to give our clients the confidence to go into a different geographical location with confidence, rather than, I'm not having to Google accountant in Dubai, right? The other thing about it, we're not tied to them, Eleanor, so we don't have to refer to them. So we only refer to advisors that we know and trust that are going to treat our clients as well as we would.
Yes. Okay, no, that's definitely good. Okay, so I reckon we've got time for one more question. So Anna, very patiently, right at the beginning, said budget mentioned that you have to have 35 years of national insurance contributions for a full state pension. But what's the minimum national insurance contribution per annum, as I only have 30 years worth, she says.
You can top up voluntarily. Okay. So there is a form that you can fill out. I think if you Google it, it will pop up, and if not, I can send the link through. You can get a test against what you've contributed and how much state pension that you would now receive if you didn't do anything. There is something called Class 2 national insurance. Sorry, not Class 2, Class 3 is voluntary. So you could top up and you could put money into that pot to effectively tick the box for the additional 5 years.
Yeah.
And
so
again,
that you get the full pension, so you get your full state pension in the end.
Exactly. But again, if you had an independent financial advisor, they'd be able to say to you, okay, well, if you put that amount in, you'll get this as a return, or I could put that same money somewhere else and get you a better return.
Yeah.
So don't go into state pension blindly, I guess is the point.
There are always, and there are always trade-offs. I mean, I think it's been fascinating talking to you both. Thank you so much. I can see that we're almost at the end of the hour. It's gone really quickly. And so many kind of great questions from you all out there. But I think that the kind of really key takeaway is it's worth going and getting some advice. Particularly, it's always worth having a will, because if you don't get a will, that's that's a whole world of pain for your descendants and incredibly expensive. And it's worth really thinking, particularly if you've got a house or any kind of asset which is worth over £1 million, and or your parents have, is taking some kind of fun inheritance tax planning, or some tax planning or financial planning kind of now. Because one of the great things about being a Queenager is that we know that we're likely to live till we're 100. And actually, at the Noon Circle the other day said, if you're relatively healthy in your 50s as a woman, you can probably expect to live till you're 97, which is fantastic. But we're also going to need some money to underpin that. And women currently have a 35% gender pension gap, which people don't talk about. So women are retiring with between 35 and 40% less in their pension than men are. So it's really important, I think, for women at this point to take some advice, kind of really work out what your options are. And there may be things out there that you can do that you have no idea about. So this is something that I was very resistant about when I first set up Noon, and having become a business owner kind of twice over, I've really realized that there's huge amount of value in taking some advice from people who know. They always will, in the long run, save you some money. And more than that, you're going to leave a real pickle for your descendants if you don't get a will and you don't do any kind of planning. And also, what I'd like to say to you all is that it's really worth putting some money in the stock market, not just keeping it in cash, because as we saw last year, that the value of your cash is being eroded all the time by inflation. Mav and Emma, do you want to have a quick kind of parting shot?
I've just put the state pension forecast link into the chat for anybody that needs it. So that will be what helps you understand what you're going to get right now, and it should talk you through next actions as well in terms of voluntary contributions.
Brilliant. Thank you so much for that, Emma. And thank you so much, Mum, and thanks for being kind of really so honest about your own. And it's really, I think, really helpful to those of us who feel we don't know very much about this to hear somebody like you, who's a brilliant accountant, who's also like had to kind of get their own finances under control. Because I think we can feel like we're the only ones who are finding this difficult. But
Yeah, absolutely. Do you know, the only thing I was going to add was that piece around going with your gut and really listening to yourself. If you don't understand something and you're not finding it coming clear, just keep asking the questions and don't let yourself be put off from finding the answer, because there's nothing wrong with your ability to understand, as the person is not explaining it to you clearly enough. So just to go away with that piece of confidence for these conversations, because they can feel quite complex, but they don't need to.
yeah, and I think that's really true, and it's okay to kind of keep asking questions. I mean, I'm a journalist, so my job is to ask questions. But I often find myself with my financial advisors going, look, hang on a sec, can you just explain that again, or get them to kind of put it on a piece of paper or give you an example, and keep asking the question until until you get an answer that makes sense to you, because it's your money and it's your future, and you have a right to advice which kind of feels right for you. And if you have an advisor who is making you feel uncomfortable when you do that, then they're the wrong advisor. Go and talk to somebody like Emma or Marv, or someone who you do, or Tony, who looks after me at BKL, and who can explain it to you in a way that does make sense, because that's really empowering. And what we're trying to do for all Queenagers is to give us all more agency, more power, more sense of control over our lives, and particularly our money as we age. Oh, brilliant. I'm so glad that so many of you have enjoyed this. Lots of chat and lots of stuff in the chat about how helpful it was, and informative and well explained. So well done, Emma and Mel, for that. We really appreciate it. And we're going to be doing some more of these. We're really happy about our partnership with BKL, because we can also see what value it brings to all of you lovely Queenagers. So whether you're watching, you've been watching live, or whether you're watching this on catch up, thanks so much for joining us. Do check out BKL. The email is queenagers@bkl.co.uk. I think that's right. Yeah, queenagers@bkl.co.uk. That is a special email just for you wonderful ladies who've come in from Noon. We entered into this partnership because these are people I trust with my own money, my own businesses, and so this is as good a recommendation as I can make. I can't do more than say these are the people that I use myself. So thank you so much, Marv. Thank you, Emma. Thanks, Jen, for being superstar in the background. Never runs smoothly without you. In fact, Jen knows far more about all of this than I do. It's really lovely to see so many of you, and I hope we see you really soon. And yeah, and hopefully we'll see lots of you at the party next week, which is being held at BKL's very swanky offices in central London. I've just ordered all the booze, which is so it's going to be.
I'll be there then, Ellen.
And Emma and Mav, you're both coming to that, aren't you?
Indeed.
Yes, so you can buttonhole them over a glass of prosecco or two. And,
I was going to say, Emma and Mav, they're going to be very busy, I bet, at the party.
Yeah. And very popular. Lovely to see you all. Thank you so much for joining us. The video of this session will also send to everybody who registered. So thanks so much.
And it will be up on our YouTube channel, and we'll do highlights on socials.
Brilliant, as ever. Thank you all. See you soon.
Thanks very much. Bye-bye.
Good luck. Take some financial advice.